Hey, Scott.
Hey,
We're good.
Excellent.
Yeah,
So we are recording.
Go ahead. Say something smart.
All right. So what I think we were getting at was going through the markets one at a time.
Yeah.
Do you want me to put up the chart? You to put up the chart? How do you want to do it?
Yeah, I'm on my wife's laptop right now, so I've put up the equities. I don't have everything set up here yet on this laptop, so maybe you can do some of the chart.
Okay. Let me,
charts this time.
That'll work better for the screen capture. So you want me to bring up the SPOOs?
Yeah, maybe while you do that, do you want me to show you something?
Please.
Okay. Let me show you this. Okay, now you can see my desktop, I hope. And one thing I want to show you, which I posted on the blog last week, was that the E-mini actually had one of its most bullish weeks, statistically speaking, last week. If you look right here, week number 15, scroll this up a little bit, and right here, in terms of not only sharp ratio,
that was an outlier.
But also in terms of SKU. I think I have this further down here.
Okay, so
yeah, this is the SKU rate. That was previous week. See that?
So for some of my viewers who don't actually understand this, why don't you just give the whistle stop tour of what this is, because this is excellent stuff.
Yeah, okay. The sharp ratio. So what I'm showing here, what I've calculated, I've got this page on Eagle Speculator I put together a few months ago, and it automatically generates statistics based on any Yahoo signal you can pull up. So my script basically goes online and then pulls the data all the way going back as far as I can, actually. In this case, I put it on right on top here.
And you guys can see this at Evil Speculator.
This on Evil Speculator, right? Yeah, it's kind of. I can probably send you the link so you can share it. It's right now still available for free.
Gotcha.
And here's, for instance, the SPY mean monthly percent change since 1993, right? And
so this is accurate seasonality stuff instead of just having to Google it and take someone's word for it.
Exactly, accurate and real time. Every week it updates itself. Right?
That was always my problem with seasonality statistics. It's like you have to really trust the guy who's generating the stats.
Exactly, because there was this guy posting on my blog, Berkshire, almost a decade ago.
I remember it.
Okay, you remember this guy, right? And he put up kick-ass statistics, and I'm like, oh, I miss Berk's statistics. They were so cool. And then, I've always been a coder, and then one day I was posting even on quant forums, like, does anyone have some decent code for some anything for generating some basic statistics? And just crickets, right? Yeah. So I said, okay, looks like I have to write it myself again, and that's what I did. So since I was getting into Python at that time, it was earlier this year, I've always been a C and Java programmer for a long time. And then I said, okay, I just got to learn Python. So I learned, how to do the chart stuff a little bit, which was a pain in the butt, but it paid off because now I have all these beautiful statistics here. And so basically, I'd give you kind of the quick tour what I'm doing here. This is monthly percent change. So it's just how much it changes, right, every month since 1993. So
that's quite a low sample size. So that one you couldn't trust as much as the others, right?
Which others?
Well, the daily one, you got 12 times as much data, right?
Yeah, that's the problem. I can only pull so much data through Yahoo because it's a free interface. I could buy data feed and actually use IQ feed to pull in more statistics, right? But actually, when did the spiders start? Didn't they start when did they start, the spiders?
Probably. Yeah, I don't know. I don't know.
Spiders, ETF, I think they started, that's going to be hard to figure out here on the fly, but, it depends on how much data it is, right? And as much data as this, I can pull it. So if more data is necessary, then I can pull it through IQ feed. But then it requires its own data feed connected to that box that's pulling it. So anyway, you want me to continue?
Please continue.
Yeah, so then here I've got mean monthly standard deviation. Right? Standard deviation is basically in terms of the range. Right?
So volatility. Right? So as a general proposition, volatility is getting lower towards the summer months, and that summer slowdown shit, and then it's gradually getting hectic around the historical September, October, where people start to get crash nervous.
Exactly, right. So you see this kind
That's
of like
cool. That's really cool.
smile pattern.
And,
yeah, it's beautiful, right?
And what I like about it is that it's not just like random bars on a histogram. What we see is a very definite decreasing in volatility and a very gradual and definite increasing in volatility. That's legitimately fascinating, dude. That's a fucking. I learned. Yeah, I had no idea, and I learned something right there, man.
Thank you. And so it obviously dips in the summer when everyone is out in the Hamptons, used to be, or on vacation, and then it really accelerates into October, which are September, October. Obviously, traditionally, I always thought to be the more bearish months. However, and I've done some research on that previously, the crash months of August and September, they're actually primarily, it's really the outliers that get those, the outliers that people usually think of. In general, August is actually a bullish month. So I actually have statistics on that as well. So here's monthly skew, right? So skew, if we're talking about skew, it's really it's kind of difficult to explain on the fly, but basically what we're talking about is when you talk about a normal distribution, right?
You're talking about how fat the tails are in essence.
Yeah, but when people talk about fat tails, what does that mean? Well, normally, if you think about a normal distribution, it's kind of like this, right? And when you have basically a bullish leaning market, right, then you would get something like this, where the tail is to the left. That's what I call.
I can't see it. Do you want me to?
Go ahead.
I can't.
Yeah, go ahead.
I'll just Google positive skew and put it up so that people can see it.
That's a good idea. I could do that too. Actually, in this case, we've been positive skew. Yeah, but positive skew is actually slightly more bearish, right?
Okay. Here we go. So, to people watching this, you can see there's a positive and a negative skew image there. You get the idea anyway. Okay, sorry, continue.
Okay, I don't see what you're showing, but I trust you show something appropriate, right?
Yeah, okay.
Do you want me to continue?
Please continue.
Okay, right. I'm not sure. I don't know what you're showing. That's why I'm asking.
Okay.
And so basically, as you're seeing, we are actually in a. We were in April. I mean, we're like today's the 23rd, so we're 2/3 through in a positive skew regime on a monthly basis, which means that you have to kind of flip. So if this is the normality, right, like this, and it's actually skewed on this end. So I'm actually mirroring it. I hope I do this right now. And that means that there are more. The tail is on the downside, right?
On the left side.
Right. Yeah. Go ahead.
So to clarify, it's imagining a big normal distribution like a camel hump, and it's leaning to the left. That's what we're talking about here.
Yeah, it's actually when you have positive distribution, actually leans to the right if you're looking at it.
Okay, so negative skew is bullish.
Negative skew is bullish. That's why you see so many red bars on this chart.
Gotcha.
Otherwise, we always have. You remember in your own videos you talk about in your own. You talk about market 80%. It goes up, right?
Yeah, and I guess this is since 1993. It's been historically a bully, pretty good long and strong time, right?
Yes, right.
Okay.
So now let me continue scrolling over here. So this is a Sharpe ratio. I think everyone knows what the Sharpe ratio is.
Mm-hmm.
And this obviously shows that April is actually the strongest month in terms of just pure earnings.
Wow. I'd always thought that this seasonality stuff was voodoo, but now I can see that it's pretty close to bang on. That's a strong edge.
Yeah, I think so too. And that's actually one reason why we went long last week before it kind of busted higher.
And so there's
a few more. There's a lot of stuff. There's monthly percent positive since 1993 again, right? So this actually shows that it's not just the outliers that make the month, right? So if it's a positive month, sometimes you have just outliers that make it. Again, skew, right? Where it be maybe skewed a little bit to the positive side, and you would and would get like these big outliers that kind of make the month stand out so much. But no, it's not the case. It's actually on average percent positives 75. What is it? 76%. That's pretty good. Monthly trading range. Okay, that's just in terms of trading range. So we have actually a little bit less volatility, and we're going to have less going into the summer. And this is by mean weekly percent change since 1993. This is now on a weekly basis. So I've decided then, okay, monthly is nice, but I'm basically showing the same things here on a weekly basis. So this is weekly percent change, and we're now in week number 16. Here, see that? Look at that. That was last week. It was actually the big reason to be long last week.
Which one was that? Which one was last week? Last week was the big long.
Yeah, last week was week number 15. So this one, right? Can you see my mouse? I'm kind of wiggling it. The long, big one, the longest one on the chart.
Yeah. Okay. So this week is a small week according to that, which actually makes sense with the price action too. I would be expecting a low volatility week with the bullish bias.
Yeah, and I think there will be probably a little bit of a sideways range. That's potentiality. It already has weakened on Friday.
I don't know if I'm seeing patterns when like mentally implying patterns, but I was looking at the price action on the chart of this, thinking that I think there'd be a very high probability of a low volatility, slightly bullish week, and that's exactly what your thing is saying. Like that's quite amazing, really.
That's very interesting, right?
Very
okay,
interesting.
so maybe you should talk when I'm gonna scroll a little bit more through this, and then maybe you can walk us through, your own analysis, what you've come up with.
Sure. And what I find really interesting is that when you take two different methods and you come up with the same conclusion, like that's, you start to put together more pieces of the puzzle that way.
That's when you're usually in trouble. You start agreeing everything. Just run for the hills, guys. Okay, here's weekly standard deviation on a weekly basis. Last week was, actually, look at that. That's very interesting. Based on your research, that seems to match what, I'm really interested in how this week is going to play out, because we said we're going to probably have a sideways week, right? If I can understand you correctly. Well, and look at the standard deviation for this week. It's almost one of the lowest of the now, except for maybe late December.
It's certainly bottom 10% in volatility for the year, right?
Yes, sir. Yeah, that's pretty good.
That's dope.
And here's school again. So, again, school last week. Actually, interesting, right? It's the school. It's this number. Oh, it's actually 17. Okay, here we go.
Dude, I'm so excited to learn a new thing. This is really, really cool stuff.
So we've got weekly school here again. And then this is more, it gets a little more in the thick here. This is return distribution since 1993. This is, again, the histogram, pardon me. And my screen is a little bit smaller right now, the laptop I'm using. I hope you can see it all. See that? This is for week number 17, which is the current week that we're in right now. And then again, weekly Sharpe ratio. See that? That was last week. That was quite massive. Look at that. Yeah. Huge. I posted this one last week all over on Twitter and stuff a few times. Make sure people knew it. I hope many people saw it, because this was really a good opportunity to get long, especially given the pattern that we saw. If I flip over here real quick, this to 0, 1 second. Tab suspended. Great. I might want to add my own site to the whitelist. 1 second. So it's one of my posts here. I'm trying to find. Here we go. So this was kind of really the entry opportunity right here. See that?
Yep.
Right. That was beautiful. It was beautiful entry.
And again, and there's some stuff I want to talk about this rally too when you finish. Yeah. But it's it was beautiful. Okay,
let me then just wrap it up, because I don't want to test your viewers' patience too much.
I'm good.
So what we have this week, mean weekly percent positive. We seem to be still pretty good here, right? We're around 68%. And trading ranges, we're okay. We're not in the upper range, so hopefully we're not getting too much volatility. We're not supposed to be, right? And then annual. So there's other stuff I actually produced here. This is maybe marginally interesting. This is mean annual percent change since 1993. That's for the entire for the entire S&P. This is more general stuff. This is very interesting, actually. See this one that's being highlighted right now? This is actually the April month, and it's actually, as you can see, one of the strongest months of the year.
Very.
This is SPY respective monthly percent change since 1993. So, and then you have quartiles. I don't know. Do you readers know what quantiles is? You basically, let's say you take all the months of the year. It's kind of what I did, right? And you basically, you have 12 buckets, right? And then you sort them, right?
Oh, so you take January, March. So you've got, okay.
Yeah, so what you do, you sort them from the weakest to the strongest. And then you split those months, that sorted list, into the sorted set in that case, into buckets, right? So if you have quartiles, it's 4 buckets, but you can have quintiles, you can have all kinds of separations, right? So in this case, it's quartiles, so I have the 4 chunks. So we have basically, as the strongest months of the year, November, April, and October. Again, October, people would be surprised to hear that, right? Then we have the January, March, May, and September, August, June are the weakest month. It's quintile 1. See that? That's the one on the bottom. See that?
Wow. That's cool.
That's very cool. So, SPY April, historical percent change, all that kind of stuff. So I don't want to, we're almost on the bottom. So if your viewers are interested in taking a whack at that, they can actually just go and, let's say they can do this, right? And type in Apple, and it's going to rattle on the back end yet. It'll actually cache the information, so our next user will be able to pull it quicker, but it's Monday morning, and now it's a new week, and Apple is loading right now. So it'll take 30 seconds to kind of load all the information and churn through it.
I've never traded with seasonality and seasonality statistics before. So to my people who are listening to this now, Mo is an extremely competent quant programmer, and I can highly recommend anything he does and says. And so, Mo, how do you go about trading this? Do you use it as a bias to your existing discretionary things? Do you trade it systematically? Could you conceive of building edges out of it? Like, how would you do it?
Okay.
How would you trade this?
Can we see? You can see me again now, right?
I can see you.
Okay. Okay, truth be told, what I did was for the last 6 months or so, since I built this, maybe 7-8 months, what I did was produce a very simple approach of taking the top percent of stocks and the low percent of stocks, lowest and highest performing.
I've been following it.
So what I did, I wrote a script that basically went through it, right, and I ran all the statistics on all the stocks in the NYSE, right, several thousand. I think came out over 6,000. And Nasdaq and S&P and the Dow and the Russell. So I basically accumulated all this information. And I had this, and I had it running every weekend, churning along, pulling data from Yahoo. One second, let me grab my drink. And so I had it churn along to create all these beautiful stats, and then spit out the end basically lowest performing and highest performing stocks based on statistics. And then also looking at earnings, so kick those out if they have earnings soon because that creates volatility.
And so what's the idea is to craft a portfolio and buy and sell at the start of the week?
Yeah, exactly. 10, 10, 10, right? You have 10 highest performing, 10 lowest performing stocks. Now, I would love to tell you that this worked well, and it did work well until about February, March, and it completely fell apart. So based on that, I would suggest the following. And I'm still working on this. And you always have to be very, very realistic about this. I think statistics should be a component of your trading approach, but it shouldn't be the only one. Gotcha. Right? Because look, it's good to
because when in February, March, that's when volatility spiked, right? So it's obvious it would whatever was working before wouldn't work after that.
Yeah, maybe, right? I think that also maybe there are periods in the year when statistics have more bearing than on the direction of the tape, and also in terms of market beta on various stocks.
I guess logically it makes sense in a low volatility time. The market is not going to be washed around by so many cross currents, and seasonality would have a bigger effect, right?
That's a good point. Yeah, that's a good point. Yeah. So you want to make sure that your system doesn't just rely I mean, in general, you want to make sure that your system doesn't just rely on one alpha factor. And when I selected this, I made the mistake of just looking at one particular alpha factor, which is statistics. And generally, for the entire stock market, that might be true. And I think that if you trade this long enough, and let me get to the actual cruise of what I think is going on. If you trade this system, it's a primitive system, right? It took a lot of coding, but in terms of, you could do this manually, right? And there's also scanners out there, so you could do all this manually. But if you just take statistics by themselves, well, it's just one alpha factor, alpha factor being
and markets are reasonably efficient, so one thing by itself can never be that strong, right?
In my experience, and my hope was when I got into algorithmic trading and trading in general, was that, okay, you find that holy grail, that one thing that works for you. For the entire stock market, yeah, but you're not trading entire stock market. Well, you could buy spiders. I think that might actually work, right? Just do the spiders this way and then be done with it. But you also have, again, it's statistics. It's a bias. And it's not an entry system. It's a bias. It's just a general direction which makes it easier. Like if you're in an inflection point in the tape, right? Sideways, right? Yeah. And then maybe there's a bullish bias. Well, then you might want to actually accumulate on the bottom. This is the same case scenario. The bias for April might be up, but we still might have some kind of surprise like on Friday where just stops. So you want to have other factors.
So it's like something you'd use as a filter over the top, or okay. This is very interesting, man.
No, you've produced this beautiful course on tape reading, right? So in the context of tape reading, if you see something that looks like it's gonna run like hell, right? The next week, it's like pinched. If you put a Bollinger in it, right? But if your readers are experienced, they can probably see it, right? When the range becomes really tight.
Why don't we just see the E-mini in that? Why don't I'll just put the E-mini up.
Please.
On the chart below. And guys,
from last week, that's a great example, actually.
So we're talking with Mole that we have a very strong bullish seasonality bias, and you can see here we've got this move off the lows. So the first thing that we want to do when we look at any chart is always say to ourselves, is it a trend or is it a trading range? And the usual thing is if you can't say for sure which one it is, then it's probably a trading range. And here we've been going in a sideways and obvious high volatility stage for a long time. Now, what we've done is we've come and retested the low here without breaking these previous lows. So you can see on these big down days, you can see the big lower wicks, which indicate that there's buying support around here, and that any break below here would be catastrophic. If the market goes below here, it's well fucked. So
that was really the line in the sand.
That's the line in the sand. Below there. So what we're looking at when we're reading the tape is looking at the point where one side or the other has to give up and say, nah, my idea was wrong, it's indefensible. But what I want to show you is something really interesting that happened last week. So we have this failure to go down, we have a retest of the lows, it goes up, and then we have 1, 2, 3, 4, 5, 6, 7, 8 days in a row where the market is so strong that it can't break the low of the previous day. So if you're looking for an objective definition of what is a strong market, objectively a strong market is one where continuously it cannot break the low of the previous day. And you see here we've just got these big strings where the market can mount selling pressure, but only intraday selling pressure. It's like watching a boxer take a punch and going, that punch just isn't hurting him. It's not hurting him. It's not hurting him. And when you get a market like that,
like you.
I'm just. It does nothing. The markets can just run and run and run. But if we look at this, can you see my? Do you want me to share my screen?
I'm looking at my own chart, so I totally follow what you're talking about.
So see the top candle in the rally last week. See how small that little bastard is. So if you look at that screen, that's the smallest candle in the whole screen. So typically when we see a candle that's ridiculously small, the following candle is going to be an increase in volatility, and that's typically the type of thing where you expect a change in momentum. So what we've seen here is with this incredibly small candle, and we've got an upper wick, and we've got two-sided buying pressure after 8 days up, it's probably time for the bears to have a crack. But the evidence is that the bears were very weak all last week. So the bears aren't going to immediately... The bears have been being punched for 8 days in a row. They are not just suddenly going to come and power the bulls away to death. So what we've got here is we've got this first bar down. See how we've got a little bit of a lower wick on it? Not too much. So what that tells us is it's going down, but it's not crashing, and there's people buying it because it's been a strong market. And then the next bar, look at how much overlap we've got here. We've probably got 60% of the bar overlap with the previous bar. Now, anytime we've got overlap, you can reasonably say that there's two-sided buying pressure there. It's not just falling off the plate. There's people trying to drive it up, people trying to drive it down. And look, there's a little lower wick here. So what that's telling me is, yeah, the market's going down, but it's not. It's fighting to go down. It's not. It's like you can see here, it just slid down the whole way. You know, on the left side of the screen, it's just falling off the plate. The next day, it's opening at the highest, closing at the lowest, falling off the plate. We're not getting that here. We're seeing overlapping bars, and we're not seeing an increase in range. An increase in range is an increase in volatility. We're not seeing any signs of it. This is only a half candle, so you can't take much notice of that. But my working hypothesis, and I think the evidence is that the bears are very weak, and the bulls are comparatively stronger. I would be very surprised if we didn't either paint a lot of overlapping bar or a low volatility rise today. And I think the highest probability is probably to chop around sideways and then eventually sometime towards the end of the week probably stop these guys out and try and rally. But it's still a trading range, so you can't expect clean moves in a trading range. It's if it breaks this high, it's going to be back to trending, but we're nowhere near that. We're only 40% of the way up.
It's very interesting what happened along the slow advance over the last week. Early in the week, I actually posted something which about the quality of the tape, and I called, what was my post called? I think it was like, I had a big face off for Swan maintenance mode. Yeah, basically, I was talking about the rally still trying to kind of get its act together. I smell a trap, here it is. And because what I saw were volatility patterns, volume patterns, which looked a little bit suspicious. I'm going to try to pull this up for you guys. So what we were early here, see that? Hold on. I forgot nobody can see my screen. Now you can, right?
All right.
So what I saw last week was we were right pinned below this volume holes right here.
Okay, so can you explain how the volume holes work for people who might not
understand? It's like basically a histogram of prior market participation in terms of volume.
This is called market profile,
where the most trading activity was happening in which regions. So when you get is that clear enough?
So this is called market profile to be correct, right?
Yeah, okay. Exactly. What I call just volatility map, market profile, participation map, all this.
Okay, so what do the little holes mean, and what do the spikes mean?
The spikes means there obviously was a lot of in this cluster, in this price cluster right here on the bottom, there was a lot of activity. There was a lot of volume. There was a lot of trading activity. And when you go into the volume holes, there's less. So you can usually assume that there, for instance, when there's strong clusters like the one on the bottom here, clearly that's one of the reasons why also it bounced here. Why? Because there's a lot of stops are there, or maybe placed just below, and the bulls will show up here to defend. Right. Gotcha. On the contrary, if you're coming from below, the bears might be waiting there. It's not an exact science to defend there.
So it's just extra resistance support.
Yeah. So you can define kind of, and I've done this over and over the last decade, and use this type of approach, and it's very simple, but it works pretty well for just assessing. And a lot of times, and actually I'm talking about 70% of the time, it lines up with actually my charts in terms of where I see inflection points. So it's just on price action.
I know some really famous people who I really respect always talk about this as being a good thing, and I know Linda Raschke swears by this, so it's Linda Raschke.
Oh, okay, Linda, yeah. Sure. Yeah.
So I've never used it, but it's really cool. I've seen you do it on your blog for years, and guys, if you're watching this, I believe the book is by Dalton, and it's called Market Profile, And you can see a whole lot of it on Mole's site, which is evilspeculator.com.
If you haven't read that book, I will definitely take a look at that. Let me walk you through this real quick,
Sure.
And then you probably want to continue with what you were saying. This is what I was a little bit worried about early on, and this is
Yuval and Devo?
I'm sorry, what?
Is this Yuval and Devo? What is this?
Yuval, yeah, and then I just basically, the magenta is the ratio between the two. Now, last Thursday, tape was going up, but it was actually Yuval was actually still advanced in terms of outrunning Buffalo.
Is this the last 3 days of last week? Is this?
Yeah, that was. Let me see. This is posted on April 13th. So that was actually 10 days ago. Wow, time flies.
Okay, so let me just find that point on the.
Yes, that's a great idea, actually.
Great. When was it? April the
13th. I think it might. Was it a Friday? I think it was a Friday 13th. This month, no?
so at that point, we were looking like it was still a bear flag.
Yes.
It was still technically. You could look at that and it's very prescient of you to say you smell a rat, because this is technically a perfect bearish setup. But you can see at this point we still have these failure to break the low of each bar, which tells us that even though that's a textbook bear flag, you look at all the textbooks, perfect triangle, it's going to resolve down. Nah, bullshit, man. Because we see a lot stronger bullish price action than we would expect at that. And you can see at this point, the bears have to get nervous.
Yeah, they had to get nervous.
And here the bears
but I don't
start
think
to
it was the back, and it's funny. Yes, go ahead.
Sorry, keep talking.
Sure, sorry. And I was actually long already. So I was introducing this post saying, in the intro, I probably should be the last one complaining, but I am smelling a rat, And so here's another chart. Can you see that?
Mm-hmm.
It's basically just a ratio between this SPX to the VIX versus the actual just cash SPX. And normally I look at that in terms of supportive, right? And it's still, although it was already pushing up, see that? And, kind of flopping all over the place. The VIX still, the market maker was still pricing in a lot of risk. Or, that's always the other part of the equation, right? The other way of thinking of that. Well, maybe they were just pushing up the prices of puts in particular. Because think about it where we are. Scott, maybe you want to, if you're bear, what are you going to think at that stage where we were on Friday 13th? What do you probably have a good chance a lot of people went short there, right?
Dude, it looks like the perfect place to go short if you're like a beginner technical analysis guy.
Yes.
So it's going to get the dumbest guys in. And if you look at the bar they shorted on, it's this spinning top sort of a bar. It's that exact guy that always wants any excuse to go short. Be
nice.
I won't say his name. I won't say his name.
Go ahead. So this was. So I looked at that now. Come on. I mean, I don't have a crystal ball, but I was a little bit concerned, and I was like, okay, this might drag it down. I mean, my position wasn't big, by the way. I never, loaded up the bus, but this was legitimately still the bear still had a chance there.
Oh yeah. But now, no.
Then didn't happen, bro. Though, however, when it actually continued higher, that you got to consider that there's all this bearish momentum that has accumulated in evidence that's for some reason not working. And as you always say, when something's supposed to happen and it doesn't happen, what happens?
Boom, the exact opposite. And I think in context, the bears have been beaten for a long time. They're exhausting a lot of their remaining ammunition right here.
Yeah.
I don't think it ends well for the bears. I think they're at this stage. I have to give the very slight advantage to the bulls. What do you think?
Yeah, it's a good question. Let me try to kind of give you my view on it. I mean, look at where we are. If you just look at, I don't have the SPX. I probably should have loaded. Next week, I'm better prepared. I just set all this up here.
Relaxed,
but this is kind of my video session set up with I've stolen my wife's laptop for it, so I had to do it a little bit in a rush. But look, what we've been through in the last 3 months, right, since the beginning of the year, It's clearly a different type of market.
What?
I mean, this is not a bull market anymore. I mean, if you listen to your own lessons, right, that you've done on tape,
it's a sideways high volatility.
Yeah, and so anything can happen. And maybe this is the big shakeout, right? It might go on until after the summer.
We could have a blow off top, but it's not behaving like one yet.
Let me just show you this. But I mean, if you just look at this chart, I mean, it's been a mess. I'm not showing a lot here, but I mean, just this, right? And you know where all this came from before, and it's just.
So what's the zero? So guys, the zero is Mole's custom indicator. It's not solely a derivative of price, which is why it's quite interesting as an indicator. I've used it before. It's a paid service, but I can recommend it. So what it does is he won't tell anyone what he's built it out of, but it only works in New York trading hours. So he's using some sort of trend or fucking market internals bullshit, mixing it in with some price action. And what it is it's an oscillator that isn't just a derivative of price. So most indicators are just price turned into a squiggle. This is something else. This has got actual buying and selling stuff into it, which means it's actually a bit more useful. You know, traditional oscillators are only useful to the extent that your previous price action stays the same as your look-back period. You know, if you get a change of market type, oscillators and indicators just stop working. But this one doesn't. This one's actually forward-looking rather than backward-looking, which is why it's reasonably interesting for the intraday trader.
Yeah, it's helped us many ways. It's more of an oscillator that describes what the market thinks, right? The market participation and momentum, and I think it does a pretty good job on that. And because when many times when we see the price do one thing, but participation signal on the zero is doing another, it plays out the other. It plays out exactly as pointed out, right?
So
for
instance, the left-hand side of the chart is a 60-minute E-mini chart for about the last month, and if you can see that when we kicked off at the start of this rally, we kicked off really quite strongly, and moves that have legs kick off quite strongly, and you can see our recent down move, the bearish participation is very small. So once again, this is another situation where the indicator is telling you the same thing as the price action is, which is that the bears are pushing it down, but they're not really doing that great a job of it.
Yeah, and what's also interesting is when you look at this, what's on the left side of the chart, the left panel shows us the hourly panel, right? Mm-hmm. And on the right, it's more for intraday, swing trading and scalping, where there's the 5-minute chart right here on the right side. So on the left side, when you look at these runs higher, right, they kind of build themselves up and then they drive higher, and then what you see is these quick spikes lower, right? Especially in the beginning phase, right? You see these big spikes lower, but they recover fairly quickly. And on the left side, the center panel is the smooth version, and on the left side, the lower panel is the more pure version. Mm-hmm. And I think that makes it more clear, right? So these spikes, and now it's easy to underestimate when you see, for instance, you could make the point here, well, the spike to the downside was quite strong, right? -2. Oh yeah, it does. But when you look at this in general, like as an overall view, the majority of the spikes are to the upside, and continue to be. However, there has been a weakening, right? If you're looking at, last Thursday and then into Friday, the signal started to weaken. So, we might not be completely done yet. I think we might get more choppiness. It's hard to say until we see the first 2 or 3 hours today of Monday when the market opens. Yeah. Fresh perspective, new week.
Yeah.
And so that'll be interesting. So that's how I usually interpret. The gold is really on the scalping side. If you love to scalp, a lot of times we see, for instance, if you would see like a bullish divergence like you see on the 5-minute panel here on the right side, during the session, that is a lot of times indicative of bullish tape to come.
So you don't pay as much attention at the end because it's just people covering their positions, or?
Yes, well, there's many reasons for it. Maybe it could be that slow accumulation is pressing it higher, right? But price is still being suppressed, right?
So in context, this looks like exactly what we were talking about again before. The Bears are pushing it down, but they're not really doing a good job, and the Bulls are ready probably to take over soon.
Yes and no. We have to see
We have to see
what happens into Monday now, because during the week, if this would happen during the week.
So
right,
we're about 2 hours from the Open right now, to clarify, right? Two or three.
It's 1:05 here in Spain right now, and so it opens in 2.5 hours.
Gotcha.
2 hours and 25 minutes from now. I haven't actually even looked at the mini yet this morning, but what we want to see is at the Open, there might be a spike up and down, but in terms of participation here on the zero, for instance, what we want to see is a positive or flat. A lot of times,
Gotcha.
flat signal is fine as long as the tape creeps higher, because the flat signal at this point during this market phase still supports the bulls, because it's still the officially perceived direction of the market, although I think it's slowly changing. Things are getting more dicey now. But the point I want to make is that if you see divergences like that, where you basically see lower highs and lower lows on the E-mini, but you see on the signal side the opposite, right? A lot of times, if you get a price entry, like a nice spike low followed by a retest and then recovery, right? That's great entry opportunity. As usual, I don't use this solely for an entry system, but it's why I haven't made a trading system out of it. You have to kind of incorporate it into your own trading activity. So if you see an entry opportunity on your chart, right, and you also see on the zero that it's has a bullish bias, or in the inverse, if you want to, if you see a short opportunity and there's a bearish divergence, it has a high probability of working out. So you want to really not just rely on one alpha factor again. That's the takeaway point. Make sense?
Makes sense, dude. This has been awesome, but we've got enough for one day. But
I guess so. You have to actually make a post now.
Man, this has been really fascinating. I legitimately learned a lot, and for my people who are reading it, you should visit this guy's blog. It's evilspeculator.com. There's all kinds of interesting stuff to learn there, and most of it's free. And he's a good guy. I know he doesn't look it, but he is. All right.
Thanks, God. Thanks for having me. It was fun. Let's do it again.